Hey, Daniel here. Welcome to another Rottweiler tax video. In this video, I'm actually going to tell you how to know what you owe, how to know how much you're going to owe in taxes at the end of the year, how to actually make the calculation properly. Not only am I going to give you that, but I'm going to tell you how much you should be withholding from each one of your commission checks to ensure you have enough to pay the tax bill. So without further ado, let's get started. So the first thing you're going to need to figure out is what is your effective marginal tax rate. As you know, the federal income tax is based on a couple of different brackets. Now, there is some confusion about brackets. A lot of people think that when your income goes into a certain level, all of your income is taxed at that bracket. That's not how it works. Let's say the first bracket is the first $10,000 of taxable income you make. You're going to be paying taxes based on that first bracket for the first $10,000 in taxable income you have, regardless of what your total taxable income is. Now, it's important to remember along the way that most states, including my own, also impose an income tax themselves. And most of these are also bracket-based, with a few exceptions like Pennsylvania. So depending on where you live, you may have to figure this out for both the federal and the state. Now, here's how you actually do it. Literally everything is broken down in your tax return, from the gross income that you had to the net income. All of your expenses get put on there. So what you want to do is look at your adjusted gross income, the amount that's actually subject to tax. If we look at the amount of income that was used to calculate how much you owe, then you can figure out what percentage of your income was the amount that you owed. So figure that out for both the federal side and the state side. Look at both tax returns. Now you have a solid estimate as to what your actual effective tax rate is. Now the next step is something I talk about a lot. You're going to need a QuickBooks file. It comes into play here because in order to know what you owe in a given year, you need to know what your estimated net income is going to be. That means you need to know what all of your income was and what all of your expenses were, and you need to eliminate as much human error in those calculations as possible. By having QuickBooks in place, you've reconciled your numbers, you know they're accurate, you know you didn't double enter anything. So now you can run a profit and loss report within QuickBooks and actually see what your net income is for a given period. You can look at that by the month, or you can look at it for the entire year. Now, what I recommend doing, just to be on the safe side, is take that percentage that you figured out earlier and add 2% to that. So say you figured out your effective tax rate for state and federal combined was 13%. So if we add 2% to that 13%, you're now at 15%. Every time you get a commission check, you want to take 15% and put it into a savings account. Let it accrue interest. When it's time for your tax payment, you already have the money set aside. Unless you had some massive spike in income, you should have more than enough there to cover it. Obviously, this is not a perfect strategy, but for more than 80% of real estate professionals, this will work just fine. So this allows you to do two things. Not only can you set aside the amount of money that you need from each commission check, but if you want to know what your total tax bill at the end of the year is going to be at any given point in time, run that accurate P&L, look at your net income number, and then take that estimation of your marginal tax rate. Figure out what percentage of your net income is that rate. Now you know roughly how much you're going to owe on your final tax return. Now, using this strategy, you are more than likely going to withhold too much, and there's a few reasons for that. The first one is very basic because when you actually go to file your tax return, you're going to have a standard deduction applied. So if you've got a bunch of money stashed in a savings account to pay the taxes, and you base it off of what your actual net income was, by the time everything's said and done, the tax return, your net income might be much lower, so the amount you owe is going to be much lower. But by using this strategy to save, you've put yourself in a position where more often than not, you'll have more than enough cash to cover the tax bill. What you won't do is end up in a situation where you don't have enough, outside of a few very specific circumstances. And look, if you're worried about it, there's no shame whatsoever in saving some extra money just in case you need to pay the tax bill. Now, most of you watching should only have the federal and state returns, but depending on where you live, you may also have a local tax return. Pennsylvania, where I'm from, is actually notorious for this. So if you have that, you want to make sure you factor that in as well. So just a quick recap. Figure out your effective tax rate. Look at your prior year tax returns, figure out what percentage of your income you paid in taxes, take that number and then add 2% to that just to be safe. That's your accurate estimate of what your effective tax rate is. Now set up QuickBooks and make sure you reconcile all of your business and credit card accounts into it. Don't mix your personal and your business accounts up in QuickBooks. You only want to use this for your business accounts. And if you don't have them, you probably should. So once you complete that second step and get QuickBooks set up, you can look at what your net income is to know roughly what your taxable income from the business is going to be at the end of the year. Now, if you want to take an extra step with this, you could factor in your standard itemized deduction into that number so you know closer to what your actual taxable income will be. But the point of this is not to make it overly complicated. I think one of the biggest challenges that people have dealing with the accounting industry is people People in my business tend to explain things from the perspective of an expert in that field. They use terminology that the taxpayer may not actually understand. So this is intended to be something simple and easy that you can do yourself. That's about going to wrap up this video. I hope you found this very helpful, and make sure you tune into our YouTube channel for more great content like this. See you soon.